Hello, this is Richard Wilson at the Family Office Club, and today I have with me Brennan. Welcome, Brennan.
Thanks, Richard.
So we're doing an investor mandate interview today with Brennan. And what type of an investor or investment firm are you?
So our firm is a relatively new player in the multifamily office space. We work exclusively with Canadian resident investors. It's interesting, actually, since we set up our shop a year and a half ago, we seem to have attracted quite a few families outside of Toronto Center. We're in and around Toronto, my team are.
Sure.
But I think what's really interesting is that the Toronto market, like most major centers, financial centers, are sort of overexhausted in the multifamily office space, whereas we've actually found great success finding some families that may have been overlooked by other multifamily offices in kind of secondary municipal settings or suburban centers. And so those families we've engaged. I think for us, the biggest thing is that we have a very comprehensive platform in terms of investment solutions and mandates that we've worked on. I guess it's a bit of a testament to the strength of our team in terms of the background, a little bit on the private equity side, a little bit on the quantitative analytics side.
Okay.
So those mandates stretch obviously through public markets, North American global equities, traditional public market fixed income, but also into the private equity space, both into fund structures, GPLPs, co-investment opportunities. We're not particular there in terms of the private equity deals and fund opportunities that we look at.
Okay.
As well, private debt, through credit markets, both those that are sort of actively traded as well as more income-focused private credit opportunities.
Sure.
And then quite a bit on the real estate side. I would say even before COVID hit, we were more focused on the multi-res space than we were on commercial office space.
Sure.
A little bit on the industrial side.
Okay. And what do you think is the main difference between a Canadian multifamily office and the U.S. multifamily office from what you have seen? Is there a different mindset? Are the regulations much more burdensome in one of the two places that you've been able to see, or any big differences just from, setting up your shop and getting your first, it sounds like dozen or 2 dozen clients in?
Yeah, I would say, I will always say, just from my 20 plus years in the business, from liaising with American colleagues, they're probably a half generation ahead of us in terms of the experience of setting up and establishing a multifamily office.
Sure.
I would say more than anything, though, it's really the terms of the service that you want to deliver to the client. And I don't think that's necessarily a Canadian, European, or US or Asian differentiation. I think it's really establishing the kind of platform that you want to build, those that focus a lot on the service side of the business, estate planning, financial, taxation, and those that maybe focus a little bit more on the competitive advantage with respect to the investments. And that's probably how we set ourselves up. And as we liaise with our Canadian and our US peers in that space, we tend to migrate perhaps a little bit more to those that are investment shops first and sort of family office services second, more than anything.
Okay. And for your real estate allocations and your fund allocations, how much of that is Canadian-based real estate, Canadian-based funds and investments versus US-based versus global?
I would say probably we're a good 40 to 50% Canadian,
Okay.
30, 40% US, with maybe a 10% allocation outside of North America. We work with one manager partner that's been terrific, supportive of us, that has a global mandate that's been really great because we have opportunities for private equity real estate with them as well as private debt, and they have a global focus. But predominantly, we have stayed in North America. For us, the combination of taxation, currency, risk exposure, we feel comfortable in sort of the return risk climate that we've been operating in those markets.
Sure. Okay. And what would be the number one investment insight that you could share that maybe you wish you knew a decade ago or 20 years ago for those earlier on in their career?
Yeah, it's interesting. I think about even what I would have learned from 3 months ago.
Right.
If we'd had this call 3 months ago, I would have said that opportunistically, there are times when a family office can sniff out opportunities that perhaps other shops can't find.
Right.
Distressed assets, sort of venture opportunities that are up and coming. But in the current climate for us, I'm not sure that distressed is exactly the place we want to add return relative to the level of risk that we're seeing right now.
Sure.
I think assets in the public market as well as on the real estate and private equity side are distressed for a reason.
Mm-hmm.
So for us, I think the biggest lesson learned is that risk management is still the most important decision that we make as
Right.
stewards of our clients' hard-earned money, just as the way they stewarded it in terms of building it through their own businesses or through generational wealth management. And
Mm-hmm.
so for us, again, I think the biggest lesson learned is really understanding the risk dynamic. And I think certainly this has taught us a lot in the private credit market in terms of the stresses that can happen in credit widening situation. Certainly those looking at the different elements of real estate in terms of the real split that's going on right now, industrial, commercial, office, multi-res, the dynamics, you cannot paint them all with the same cloth. And I think it's really important to understand the risk exposures within each one of those subs of that asset class.
Right. Right. Yeah, no, for sure. I agree. I've seen, self-storage, for example, in some cases, doing quite well right now as people, leave some of their office spaces and, they're still paying that low cost self-storage bill without a lot of stress. And
Right.
I'm surprised to hear decently good numbers on multifamily office park, to the point where I'm scared that some of the things I'm being told are not true because it just seems like the amount of people unemployed that workforce housing has to get hurt real bad at some point, you would think. But we'll see. In the U.S., at least, we have this unemployment funding for the unemployed going on till the end of July with PPP money that's still lasting out there for another 2 to 6 weeks for different organizations. So it'll be interesting to see how this later summer goes. But to your point, things are distressed for a reason right now, and no one knows if it's just going to get worse or get better, right? That's kind of like
Yeah, we have the
hinting
same wage subsidy and business benefit opportunities here.
Mm-hmm.
And you're right, as those start to wind down, I was on the phone with a client this morning who actually runs, they're literally in the fast food business, and they said they've been supported by the fact that there are wage subsidies and people are able to, that's still part of their disposable income. But at some point, and I know there's been some US states that have sort of turned it the other way and started turning it from wage subsidies into wage incentives to get people off the collecting business and back into the working business and incenting them to do so. But yeah, I think consumer spending is impaired for a while, and in as much as the public markets miraculously have had a recovery, I think those employment numbers are going to take a while for us. So again, when we sort of think about the mandates that we're hunting for, we really believe we're in this sort of barbell market. You've got very low interest rates at one end of the spectrum, very hard to find traditional income. And then the other end, you've got still this sort of growth, euphoric public market. Neither one, I would argue, is the most reliable source of returns going forward. So we've looked at infrastructure, we've looked at some sustainable farming, some green energy, really those that allow you to de-risk from that consumer spending model that may be a little bit more difficult to navigate going forward. So those are the opportunities that I think we spent more time on over the last couple of months, and we'll continue to look for going forward.
Great. Yeah, no, that makes a lot of sense. I'll have Vanessa reach out. We have 1 or 2 discussion panels coming up in late July and August that could be a fit if it fits your schedule for one of our weekly virtual discussion panels. So it'd be great to discuss that. And then also, I'm happy to keep in touch. If anyone listening here wants to connect with Brennan, and they have a family that would like to speak with him and his team to see if they should be working together, or you want to discuss a deal or a company that you operate that could be a fit with what we were just discussing, just let our team know, and we're happy to make that connection as long as you're a member of the Family Office Club. And that's kind of the point of these mandates, is to share insights, but also be making connections, since we can't be hosting live events right now. So appreciate your time here, Brennan, and hope to see you back on one of our panels in the future.
Thanks so much, Richard. Really appreciate it.
Yeah, thank you. Take care.
All right, thanks.